Hi guys, welcome to the new session of business analysis. Today we will be talking about a very powerful investment framework that is how to generate alpha. So, as all legendary investors have consistently told, generating good alpha is nothing but identifying market patterns that have worked historically. Just follow them, right? And obviously not every pattern works in the future too, but it's about pattern recognition. For example, I will take a very simple example. If a business which is not over owned by FII DIIs and the entire sector is suddenly starts hitting 52-week high, so you have price movement there, people don't own it, and if you can figure out some short-term earning triggers there, the reward can be huge. This is a pattern. For example, this is a pattern. Okay. So today we will be talking about one of the most powerful patterns that have helped people generate good alpha. That's being in the right sector rather than the right stock. And a lot of people don't understand the power of being in the right sector, right? And again, we'll back it up with data so that you guys can have very, very powerful conclusions. A lot of effort in equity markets, in investment banking goes into figuring out the next best stock or the next best business, right? But according to us, as per the data that we have crunched, we have analyzed, we have read, actually being allocated towards the right theme or right sector provides the biggest chance of generating good portfolio returns over a long period of time. Similarly, if you talk about venture capital or private equity, being in the right space is equally important as buying the betting on the right kind of founder only, right? So let's talk from the listed space perspective once. Let's imagine, and we'll talk about various stock market cycles that have happened in the past. Let's imagine we are talking about the great bull run that started from April 2003 till December 2007. So the best sector during this time frame was the capital goods sector. The entire index actually went up, broadly speaking, by 18-19 times. मतलब ₹1 आपका हो गया 18-19 रुपए. Versus the worst sector at that point of time was FMCG, right? During that time frame, everyone have heard the stories of HUL not providing any great return at that point of time. So the stark difference in wealth creation between two money managers, two investors would have been this one big factor who was mainly allocated towards capital goods sector versus who was majorly allocated towards FMCG sector. Why? Because even the worst company into the best sector ended up providing much higher return than the best company of the worst sector. Focus on my language very clearly. The worst company of the best sector ended up providing much greater returns than the best company of the worst sector. So the HULs and Nestle during that time frame of April 2023 till December 2027 went up by roughly 50% and 180% approximately. Whereas capital good companies, even the worst companies like, because with hindsight bias we can say worst companies like ABB Shipyard went up 24x, right? Some decent companies like Crompton Graves so went up by 44x. So when you see the best companies in the worst sector like FMCGs were by far underperforming even mediocre companies like ABB Shipyard of the best performing sector of that time frame, that was capital goods. Now if you talk about the next cycle that started, I have the data in front of me, December 2007 to February 2009, that was a grounding down cycle, right? So the best sector during that time frame was FMCG because it only fell by 12%, and the worst sector was realty that fell by 89%. So again, if you talk about Nestle, for example, of FMCG, Nestle went down by only 1%, whereas in reality, even the biggest giant of reality like DLF. I'm not talking about that kind of Unitex here. We're talking about DLF. DLF went down by 86%. So again, an okayish company, good company, but in the best sector, FMCG, outperformed by far even the best company, DLF, of the worst sector, reality, during this cycle. Let's talk about the next cycle that started from February 2019, December 2010. There was a sharp uptick in the market. Then again it went down till 2013. But Feb 2019, December 2010 was the next upcycle. And again, the best business here was consumer durable, right? Voltas, Vagera, etc. Consumer durable company, Whirlpool, etc. Right? So consumer durable broad theme went up by approximately 3 times. And the worst sector during this time frame was telecom. Between Feb 2009 to December 2010, telecom hardly moved by 9-10%. So during this time frame, Titan, for example, into a consumer durable sector went up by approximately 400%. Whereas Reliance Communication, let's imagine, to telecom, went down by 7%. Correct? At that point of time, it was among the best company to telecom, right? It went down by 7%. Let's talk about the next cycle. We can pick any cycle here. Let's imagine February 16 to December 19 was a reasonable time frame where banking went up by approximately 140%. It was the best performing sector of that time. Whereas healthcare, everyone knows the great pharma down cycle of that period because of excessive competition in the generic space of United States. So healthcare broadly went down by -12%, correct? So even if you would have been the best company, Sun Pharma, but in a worse sector, you would have able to do nothing because Sun Pharma itself went down by 50% during that time frame. Whereas today everyone knows ICICI Bank is a great company, but at that point of time, it was okay. She was struggling from sharp NPs and recovering. But even ICICI Bank ended up giving you a 220% return, correct, during that time frame. So my point is, the key learning out of this discussion is figure out the right sectoral themes, figure out the right sector trends that you believe can be provide you good earning visibility for the coming 1 to 3 years time frame. That's the max you need to think. Please don't go into bookish stuff like figure out 20-30 year consumer trends. It's okay to figure that out, but money can't be made. You need to still figure out the short-term earning cycles of 2-3 years to make alpha, rotate your money, correct? So figure out the coming 1 to 3 years kind of market cycle where you believe the earnings can grow the fastest, and lot of time you will find that cluster into sectors कि ये 2-3 sectors के अंदर major earning tailwind दिख रहा है. Try to allocate majority portion of your portfolio into those sectors, correct? So widen your circle of competence, because sometimes those sector would be IT, sometimes it would be commodity, sometimes it would be FMCG, but you need to be in that space for your portfolio to generate large amount of wealth, not just reasonable return, but actually the kind of wealth you come into equities for. So that would be a big learning for today's section. Sector selection is of paramount importance rather than just stock selection. Okay, please try to apply this in your investing framework. Individuals from all domains, iBanking, equity, portfolio, VCP, it would be applicable to all. Just use that, right? And I will see you back in next session. Thank you so much for watching the session.